Great to have you back. Uh, it's a ring of all-time high, which has got everyone happy and puzzled. Happy because everybody loves an all-time high on the screen, but puzzled because this all-time high has happened at a time when nobody was expecting it. PSU banks are leading the price action, good old cyclicals are making a comeback, and the classic compounders like HDFC Bank, Kotak, IT, all of them are taking a backseat.
Look, none of this is unexpected. I mean, I think the justification for the all-time high is actually quite sound. In that we got the tightest job market I can think of in Indian history for formal employment. We got the tightest job market in Indian history. Secondly, we've got a situation where foreign investor inflows are picking just in the last couple of months. They've started picking up as foreign investor flows stay resilient through 2023. I think the market should hit several all-time highs, and also in these sorts of circumstances, right, when you have a economic pickup and foreign money starts coming in, the sorts of companies you mentioned, Nikunj, tend to do well. PSUs, I think you guys were mentioning BHEL, Coal India has had a terrific run, State Bank of India. These are classic plays for early stage of an economic pickup. So nothing surprising here. I think 2023 will continue bringing good economic news and for more foreign money. Domestic flows are also holding up pretty well. So I won't be surprised if the all-time high story in inverted commas sustains right through the next 12 months.
You still continue to believe that the choice of stocks which you are betting on, whether it is private banks or classics like Asian Paints and Pidilite, is the way to invest? The reason I'm asking you this is because that style of investing of late has drawn a lot of criticism.
Look, I mean, we're not here to garner popularity, right? Our job is to look after clients' money carefully. And if I look at the last 4 years, Marcellus is now, we've been managing money in Marcellus for more than 4 years. We've doubled our clients' money net of all fees at a time, and that's roughly 19% compounding net of all fees at a time when the Nifty has done around 15%. And that's been the case over long periods of time. If you follow our style of investing, you'll get a decent result, significantly ahead of the Nifty after all fees. Now, obviously, in that process, you will go through periods where I think the last 12 months we are up 1%, and the Nifty is up 6 or 7% on a total return basis. You'll go through periods of underperformance, but people like us have to be pretty relaxed about that. If we sort of every day woke up in the morning and said, "Aaj index ko beat karna hai," we will also end up buying things like State Bank of India and Coal India, which is not a good way for us to manage the public's money. So I've been here before. I've been doing this for 20 years. I've seen these cycles. We understand why a SBI or a Coal India has done well for the last couple of years. But to our mind, the stock price is not the reason, is not not the true reflection of a company's performance on a short-term basis. It's over longer time periods that just to take an example, an HDFC Bank stands out head and shoulders above a SBI. And if somebody wants to get into the fundamentals of it, HDFC Bank and SBI have the same ROE. HDFC Bank delivers the ROE as SBI on half the debt equity. And I think that tells us, as fundamentally oriented investors, everything we need to know about an HDFC Bank. So we stay calm, do what we have done for a long period of time, and that's how we protect our clients' money and give them decent compounding.
Sure. But sort of if you had to make money or did make money in the year gone by, you couldn't have possibly ignored the PSU space, right? And including PSBs, which you just, gave your views on. Anything within PSUs where you find comfort to buy still or have already invested?
So there's two reasons why we've historically avoided PSUs and we continue to avoid PSUs. One is there's a fundamental conflict of interest. There's a tension inside the PSUs construct. The PSU is owned by the government of India, and quite rightly, therefore, the PSU prioritizes the interests of the nation over the interests of the shareholder. We think that's a perfectly valid imperative. Imagine, right, a defense PSU. The defense PSU is owned by the government to protect the nation. It's not owned by the government to deliver returns for Marcellus's clients, right? So for the first reason for avoiding PSUs is the inherent tension in the PSU construct, and that doesn't make us feel very comfortable as shareholders. The second aspect is if you look at the fundamentals of PSUs, and you can take whether you take SBI or a BHEL or a Coal India, take any PSU, return on capital tends to be significantly below cost of capital over extended periods of time, which means the value creation engine is missing. Now, I can get very wrapped up in PE multiples and PB multiples and buy these things, but basic financial analysis tells you that if a business lacks a value creation engine, it's difficult for me to put my clients' difficult for me to put my clients' money at work and expect a return. It might come through from time to time, but that's sporadic and that's speculation rather than investing. So those are the two reasons for staying away from PSUs and continuing to invest in the stocks that Nikunj mentioned a couple of minutes ago.
So, any new little champs that you've been scouting for your investors?
No, so not a little champ, quite the reverse actually. So some of our advisory portfolios over the last couple of weeks, we bought Infosys, and we think this is the right time. We've historically had TCS, which we continue to have, and again, I get very amused when I see brokers sort of say underweight IT or underperformance in IT coming up, because that's like saying, take a short position in steam engines at the heart of the industrial revolution, right? Everything we are seeing in the world around us suggests that the whole world, especially the Western world, will have to automate further, will have to go to the cloud even more. And firms like TCS and Infosys are the kind of the sources, the workers who take the West into the world of automation and cloud. So we've used the sort of the whole skepticism around IT services, and this we fear that West may downturn AIGA and hence Indian IT services will be badly affected. We've used that to put Infosys in our advisory portfolios, and we continue with our TCS holding in our flagship product.
Shareholders of a lot of these companies will be taking comfort from that commentary, especially in light of the fact that of late IT has been under the weather, to put it mildly. So sort of other than that, let's also understand your outlook on the entire consumption space, because perhaps the only niggling concern or point of contention is that are those hefty valuations justified?
So I think in consumption, I think it's worth drawing a bifurcation, right? We have the tightest job market in Indian history in formal employment, right? I've never seen anything like it. I just finished a call with my colleagues and with our HR team. Whichever part of Marcellus I look at, whether it's technology, whether it is compliance, finance, operations, research, getting good people is getting tighter and tighter because the job market is so super hot, which means obviously elite consumption, right? Stuff like apparel, consumer durables, and everything around our building materials piece. I think all of that stuff will smell of roses, and I don't think there'll be a challenge through 2023 on earnings growth there. Where I think there is a challenge is the informal sector has been pulverized over 3-4 years now, and this high inflation is hammering the informal sector even more. And because unskilled employment in India, there is no stimulus around it. Unskilled employment is a challenge, and therefore in our portfolio, I can see companies which are a play on small ticket, mass, unskilled consumption. There is a general challenge in the country. So whether you look at the FMCG companies' results, or say in our portfolio in Little Champs, I look at Amrutanjan, something like pain relief. Pain relief, you think, is the world's most resilient category, but even in the pain relief portfolio in Amrutanjan, they are barely seeing any growth. So that's where we are. We're trying to do more work to see, is there any reason to believe that in 2023 there'll be a miracle and there'll be a pickup in mass consumption. At the moment, that's where our concerns are greater. In class consumption, middle class, affluent people, I think we got a rocking story at the moment.
Okay, fair enough. That's the view coming in on the entire consumption space. What about defense as an opportunity? Because a lot of those stocks, railways and etc., have certainly been the cynosure of all eyes.
So I think this is an area where we are hoping that there will be some companies we could buy. But at the moment, the listed space, right? You have companies which are either public owned, and I explained my concern that if you're a public sector company, your goal is to serve the nation rather than the minority shareholder. The private sector players in defense in our country, their cash flows tend to be quite weak, partly because working capital cycles are quite extended. It takes time to get paid if your customer is the government. And bargaining power of private sector defense players is also quite weak. So whilst we have some private sector defense players, if you look at their performance, free cash flows, making money tends to be a challenge, and hence hitherto we have never made investments in the sector. But we'll carry on looking, hopefully as India indigenizes its $70 billion defense spend, which currently goes overseas, as India indigenizes that, we might get some local companies who actually make some money out of supplying defense to the armed forces in our country.
Saurabh Mukherjea, good morning. This is Nantara joining in from Delhi. I managed to get hold of one of the notes that you had sent to your clients as far as consistent compounders goes. And there what I did see, this was in the month of November, that you folks decided to exit ITC. ITC, which has given a 57% return year to date so far. What is the rationale for that? Can you explain it to our viewers? Why is it that you may be changing your mind on ITC, or have you not changed your mind? The stock is almost at 350 rupees.
So Nandana, the note that you saw was the 4-year review of the consistent compounders product. It hit its 4th anniversary, and we reviewed performance over the 4 years. And that's where we highlighted that it has doubled our clients' money net of fees over those 4 years. Now, ITC we actually exited last year, and because we had to give a 4-year review on where we made money over the last 4 years. ITC was part of that note. We exited ITC last year largely because they have a massive cash pile. And they have a cash pile for obvious reasons. Their cigarette dominance makes them the best part of $1 billion of cash a year. But we exited it because we couldn't quite see how they were going to deploy that enormous cash pile. And to this day, we stay on the lookout for a positive announcement from Mr. Puri or the broader board at ITC. We stay on the lookout for a more positive announcement for them as to how they use their cash pile, which I think is now the best part of $4 billion, right? It's one of the most formidable cash piles in corporate India. Its dominance in cigarettes is unquestionable, but unless they use the fruits of that dominance, which is this enormous pile of free cash flow, unless they use that constructively for shareholders, it's difficult for us to see where the long-term compounding engine lies there.
Okay, so can I say that you missed the ITC party? Would that therefore be a fair thing to say, and would you reevaluate it?
We missed the State Bank of India party. We missed the ITC party. I could go on, but that's the nature of the beast, right? If we come in as traders to this job, it gives our clients a very different risk-return profile, and our job is to make money for our clients consistently, as the product says, without taking inordinate risk around speculative investments.
Right. Okay. On that honest and candid note, Saurabh, great to have you in the show as always.
Thank you. Thank you for inviting me.
Okay, let's